The tax landscape just changed. Again, the newly signed One Big Beautiful Bill Act reshapes how individuals are taxed with major implications for high-income earners. Let's start with what's locked in. The current 7 tax brackets, up to 37%, are now permanent. Good thing. The standard deduction increases to $31,500 for joint filers in 2025, and it will adjust for inflation going forward. The child tax credit rises to $2,200 per child permanently. And for those planning generational wealth, the lifetime gift and estate tax exemption jumps to $30 million for couples. But several new deductions are temporary, and they apply from 2025 through 2028. First, the SALT cap. It's been temporarily raised to $40,000 but phases out for high-income earners. And in 2030, it drops back down to $10,000. Next, there are a few deductions for tip income, up to $25,000, and for overtime pay, also up to $25,000 for joint filers. Both come with income-based phase-outs. Also, there's a new deduction for U.S. assembled electric vehicle loan interest up to $10,000. If you're 65 and older, you'll get an additional $6,000 deduction. Again, subject to income limits. Starting in 2026, there's a new above-the-line charitable deduction, up to $2,000 for joint filers, even if you don't itemize. So what does this all mean? First, the bill avoids tax hikes that would have occurred if the Trump-era provisions had expired. Second, high-income earners may benefit, but only if they plan around the temporary nature of these deductions. Third, some clean energy credits from the Inflation Reduction Act are now gone, which may impact your vehicle and investment decisions. And finally, this bill locks in key tax rules. For now, but that doesn't mean things won't shift again the next Congress or administration. This legislation is both an opportunity but potentially a challenge. If you're navigating estate planning, charitable giving, or income management between now and 2028, now is the time to reassess your strategy. Let's keep moving forward together.